get a check on what's playing out in the commodities market now. Dumebi Oluwole joins us. Great to have you, Dumebi. Good morning. Yes, so we have the final decision. That's for the interest rate decision for the year. And there was a whole decision. Let's circle back on that quickly. How surprised were you?
Well, I wasn't actually. Remember on Tuesday when we spoke, I did mention that I expected that the central bank will be very cautious, even if they did decide to even reduce interest rates. So the whole decision wasn't surprising to me. It was very much, in fact, a part of the play that I did expect. As a matter of fact, in my analysis, if they were going to cut rates, it would have been between 25 basis points to 50 basis points. Which would have still been very, very cautious. So, no, I wasn't surprised about the decision.
So how would you describe this decision? Would you say it was hawkish or dovish hawkish?
I mean, I think I'll just leave it at it being a cautious decision. Not necessarily hawkish, because they're not increasing interest rates, and not necessarily dovish because the decline in interest or the rate reduction has only happened once. What this tells us actually is that they're signaling to the broader investment climate that interest rates will still remain elevated, and this is expected to, number one, continue to prop up investments towards short-term securities. We've seen FPI inflows more than triple, at least in the last 2 years, if not 1 year, and we expect that trend to continue just based off of this decision that the MPC took. More importantly, it's to reinforce the disinflation path, right? We have seen inflation significantly decline. But as I mentioned on Tuesday, the decline has been primarily driven by base effects. And we are still seeing insecurity, significantly impact food production hotspots that tell us that food inflation could likely reverse the downward trend in the near term. And this decision is trying to get ahead of that to, number one, anchor inflation expectations, number two, anchor exchange rate expectations, and number three, reinforce the disinflation path. I will say the final thing on this is, of course, the decision in September, if you remember, not only came with a decline in interest rates, but also a decline in the CRR. And what this does with the November interest rate decision, which has kept the MPR stable, is that we will still likely see that CRR kind of support the interest rates remaining stable. And what that means is that market liquidity will still be very much in play here, and with market liquidity in play, it means that commercial banks still have access to cash to disburse, to lend out to people. So meaning that there will still be credit access, just that lending rates would not decline.
All right, so I guess maybe we'll just agree on dovish hawkish at this point.
Yeah,
we have to agree on something. Dovish hawkish.
Yes.
All right.
Hawkish.
Let's look at money supply now. We have data for that increased by 10.2% to 119 trillion. That's for October. How are you seeing that?
I will say, with the fact that CRR was reduced, this was very much expected. If you break down the numbers, you see that market liquidity is really what is driving the increase in money supply. Cash in circulation as well has also, we also see an uptick in there, and that's one of the reasons why money supply growth is increasing. But we do expect that the central bank will try to contain this level of increase. Remember that we're coming from a world where money supply had significantly increased by over 50%, almost even over 70%, right? And what we're seeing now is not necessarily up to that amount, but we do expect that the central bank would work towards containing the increase in money supply, just so that the theoretical part of inflation, where we have too much money chasing too few goods, is contained, and we don't see inflation significantly increase, or at least being driven by money supply factors.
All right, let's pivot to the oil market now. We're still seeing that range trade, and a lot of geopolitics driving
Yes.
sentiment here. But how likely
Yes.
is, a potential Ukraine-Russia ceasefire? That's supposed to ease Western sanctions on Russia, and then we get Russian oil, back in the market. What could this mean
Yes.
for global crude prices? Definitely we hope for peace, at this point.
Yes, we do hope for peace. I will say that the peace deal, it might take some time, or it definitely will take some time before we see that agreement, because right now all stakeholders have their, interests at play here. There was a reversal on the initial 28-point, deal that was proposed by Trump, and that is coming from European leaders, and the conversation around that being changed and how Moscow is taking it is definitely one to watch out for. And basically what this tells us is that the peace deal will take some time before all parties feel happy about the compromise that they will have to make. But what we are seeing definitely is that if this deal pulls through, oil prices would likely fall because there will be an increase in oil supply. It might be gradual, but the decline in oil prices is almost looking very much in sight. We are already seeing crude oil futures decline, and that obviously tells us what future price and what market sentiments are beginning to anticipate or expect to happen. And if future prices are already falling, it means that not long after, spot prices will follow suit. And if oil prices decline, what that means for Nigeria, of course, is a potential decline in oil revenue. But I will give this caveat that an increase in oil production for Nigeria is much more important, because if we increase our oil production to meet the corresponding oil price, we would likely see the increase in oil production cushion the impact of lower oil prices. But then again, this points to the fact that oil production has to significantly increase. We haven't seen oil production we haven't seen crude oil prices plus condensate, hit that 2 million barrel mark that that the fiscal budget is working with. And I'm sure that going to 2026, there are expectations for an increase even beyond the 2 million barrel per day, mark. And if we're unable to hit that, then of course it's a very, very big issue, a big challenge if oil prices significantly fall. And right now it's looking like oil prices will retain that trend below $60 per barrel.
All right, thank you so much, Dumebi. We'll keep tracking those prices. Not much has changed this week, though, but we see WTI there still sub $60. Thank you so much for joining us today.
Thank you for having me.